As we progress through the winter, there's always that lumpiness, as we were talking about with weather. Winter weather is treacherous, and especially in places that isn't built for snow or isn't used to some of the ice in terms of winterized capacity. So that's where, as you get some of these impacts, you get some of the extreme weather that creates extra lumpiness outside of what we already know to be supply chain issues, truck driver issues. So this is just going to exacerbate some of those problems. We did have a decent sized storm come through the New England, tri-state area, which created a lot of snow. So you had a lot of people filling up on Thursday, and then a decent drop off in activity throughout the weekend. But now you have a much wider swath of area that is going to be hit with ice, sleet, freezing rain, which again is going to create where Tuesday you had a big spike in activity in terms of people just filling up. But how quickly that can be pulled from the system as to how the EIA calculates it is going to increase or decrease where some of that demand is. Net, as we continue to say, and as we're seeing, prices are going higher, wages are going down, real wages are going down. We're actually going to have a bigger show on it, because now that we have a lot of new data in the Econ show, we're going to do a deep dive on where are savings as of right now, where are wages as of right now, what do we expect inflation to do over the next few quarters, because we've had some conversations with clients and we were expecting January to moderate a bit, and then same with February. Instead, we've had just an explosion in prices on gasoline, on diesel, on a lot of these flexible indicators, which again is going to put us at a higher end of, I think, the targeted rate. And we continue to see that inflation increase in Europe back to all-time highs in some areas. But again, those are things that we'll talk about in the Econ show. So what we're saying that now is because that's something that we do think is going to continue to impact the demand side of the equation. Because if you don't have to drive in the winter and there's nowhere to go, you're not trying to get out, it's just kind of, sloppy weather, you'll stay home. And then the fact that you look at prices, you're like, yeah, I'm not paying that. If I can save this tank of gas, I will. So right when we look at what it was, we had the increase versus last week. So the total numbers as we described them are the demand was 14.91 million barrels a day. Last week was 14.985. So there was a little bit of that slowdown. We think that accelerates, and then again getting closer to the average of 14.5. We were expecting to come a little bit closer, if not just below where we were for the 14,000. Instead, we're hanging in pretty close to where we were in 2020. When you look at just, again, all of this is we're obviously better than 2021 right now. But when you look at it, you can see we're below 2020, 2019, 2018, but we're still slightly above 2017. So that's something that we expect to stay below those 3 years as things really kind of flatline and actually start to trend lower again as we start to normalize against some of those elevated levels, which is why we talk about the averages so much. Now, when we look at distillate stock drew 2.41 million. That's 28.8 below the 5-year average. And then when you look at where the draws were, it was not surprising, Pad 1 and Pad 3. Pad 1, again, heating oil, diesel demand. When you look at where the draws were, so Pad 1 is 16.6 million below the 5-year average. And a lot of that, so there's some additional flow coming from Asia. That's something that we do think accelerates a bit. But when you look at the middle distillate side, the diesel side in the global market, it's a fairly tight market. So it's not like we can attract a lot of a big increase in imports, keeping us fairly tight. So we should start to see that adjust as as weather moderates a bit, but at the same time as refiners start to increase activity. The bigger problem is we have a fairly sluggish refinery utilization rate, which is good for diesel, but even with such a low rate, you're still seeing some sizable build in gasoline, which is going to be a little bit of a problem on how quickly they can address the diesel side, given the knock-on effects when you make diesel and making gasoline. So in the import front, a small increase of 25,000 barrels a day. It was increased by Pad 1. bringing us to 251,000 barrels a day. We expect that to actually climb higher a bit, and not by much. Like we're talking about, we're 59,000 barrels a day below the 5-year average. So we expect to be pretty close to, if not right at the 5-year average. So a small increase again as we go into next week. So now when we look at demand in distillate, as we were saying, with how cold it was, with the trucking demand, we expected to stay at near all-time highs or at all-time highs. On the diesel side, you can see we're right there. We expect a small moderation, not on the trucking side, just because some of the weather got a bit warmer. Now it's getting a little bit colder. So just that mix of when you take deliveries, how those deliveries are recognized, is going to adjust kind of how they show up over the next few weeks. And here's trucking. As we were saying, between that 170, 185, we're going to be stuck right there. It's, again, just load availability, all of the bullish things that are indicative of very strong trucking demand, which obviously is going to pull a lot of that diesel into the market. Rail side, as we were saying, we expected to see a decent increase. We got it. Total carloads were 1.5% above the 2021 average. That's going to continue, especially when you look at coal, farm products, forest products, grains. Even though it's down against a very tough comp. So we're still going to see a lot of bullishness around that. Motor vehicles still struggling, obviously, on the supply chain side, but starting to get a little bit better. And then when we look at intermodal starting to recover a bit, kind of around what we were saying, being about 10 to 8% below what we were in 2021, but still just a lot of that congestion, but a lot of demand, just given what is still sitting on the coast, which, as you can see, is a lot of product. So when you look against the previous year, which, as we know, we still had a lot of product out there, going through pretty much the most of February, we're going to continue to see boats show up, and that's going to keep things very robust and a lot of product moving through that supply chain. So again, putting that bid within the rail and trucking side. So if you remember last week, the New England side, you can see that there was it was warmer. Now it's gotten a little bit cooler. But you can see where we get that deep freeze coming through the South. Now, the South does not use heating oil the way we use heating oil in the Northeast or in the North. So you are getting some above average temperatures in the North. That's going to decline or decrease some of that consumption. If you look at where temperatures are in the New England area, even though it's slightly below, again, you're still fairly normal, so we don't see a huge increase on the heating oil side. This chart is very bullish on the natural gas front, from potential freeze-offs, from that demand level, because when you look at the South, there's a lot of electrified heat. That just means that you're going to bring more peakers online. You're going to bring more activity, which is, again, going to absorb that natural gas. So that's more along the lines of what that's going to do for natural gas. And then on the knock-on that, as well as for propane. So this is a bullish backdrop for natural gas and propane. And I would say fairly flattish, really, for the heating oil front. Now, when we turn to gasoline had a build of 2.12 million barrels. You can see that's 3.1 million below the 5-year average, but the 5-year average has that really tough comp, obviously, because of 2021. But you can see that we are continuing to approach that, and that's something that we think is going to continue, and the builds will run through essentially that 3rd to 4th week of February, and then start to see a bit of that drop in general. Now, when we look at imports, you can see imports increased 120,000 barrels a day. That's 73,000 below the 5-year average, bringing us to 433,000 below, per day. All of that going into pad 1. We think that, again, that stays fairly close to normal. And we will get a little bit of an increase based on the additional cargoes coming from Europe due to the fact that they continue to see their storage build. And pad 1, even though when you look at the pads in general, pad 1 is still has the most storage available, which again is going to attract some of that capacity coming over. keeping things fairly well stable. But then when you look at the blending components, it rose 2.94 million. That's now 3.8 million above the 5-year average and trending higher, which again is going to put some of that pressure on the top end of the stack when you're thinking about the refining process. So gasoline is not on the very bullish at this point. And if anything, it could get much a bit worse when you look at diesel being the target, and what does that mean for going forward. So now when we look at driving activity, it's not surprising to see a bounce in China, given the fact that Lunar New Year did begin. So again, when you look at some of those shifts, that's something that will ebb and then have a bigger drop, especially when you look at just the seasonal norm. Google mobility data, fairly flat. This is something where we expect it to just go sideways a bit. That's just because of Omicron, just because of activity. We've had a little bit of an increase, and now that we've gotten back to that a little bit of normal, now I think we go sideways. And when you look at Apple mobility data, it's showing something similar. Now, when we turn to Gas Buddy, you can see that big drop that we were expecting last week came to fruition. Now we have that sizable increase. But whenever we talk about normals and averages in general, we want to go against the 4-week average. So it was 1.9% above the 4-week average. And I think it's important to say that when we look at the 4-week average, we expect it to be 1% above, 1% below, and really stay within a fairly tight range. You had a lot of people, again, pulling things forward last week. When you're looking at that for the demand coming for the different snowstorms, now you have another one that's going to pull things forward. But then how much that impacts could shut things down and again create a little bit of a drop in general when you're looking at week on week. But within the 4-week average, I mean, it could be 1% below, but again, still fairly tight in this range. Now, one of the bigger things that continues to be an overarching theme, is the big increase in gasoline prices. Gasoline was up 4.5 cents again, coming to $3.368 on a national level. So you're still seeing this grind higher. We are getting into a fairly damaging position when you're looking at some of these elevated levels. And then when you take that and look at diesel, it's that much worse. So the increase was actually 6.6 cents, and it actually went to $3.846. So almost $3.85 on the diesel front, which is going to hit heating oil and is going to hit supply chains because most of the time, if not all of the time, labor and fuel is a straight pass through. And so as you continue to get this coming through, we've heard it from Unilever, we've heard it from Kimberly-Clark, there is going to be a huge overhang when we're looking at pricing, and all of these just keep that bid on the flexible inflation front as we continue to see that sticky inflation grinding higher and creating that longer term impact that the Fed is trying to stave off. Just putting into perspective on the blending component side, you can see that the only time it was higher was shocking, 2021. And otherwise, if it wasn't for obviously last year, this would be a seasonally adjusted all-time high. And we expect it to continue to go higher. And this is a better gauge of where gasoline storage will be. And that's where, we look at where this is going, and we think it's going to continue to trend up. On the demand front, you can see that we're now below, again, not the smoothed out numbers and the averages, but you can see we're now very far below where we were on some of the other seasonal periods. But now we're actually below 2017. And the only time it was lower was in 2021. So again, you're still seeing that those impacts. Some of this is weather, some of this is Omicron, but I think as Omicron goes away, people, I think, are going to have to start to recognize that, is this a bit more? Is this more economically driven? Is there more pressure on the retail community, the consumer? And I think that's going to shake up some of that support that we've seen in some of the current pricing metrics. Now, when we look at the U.S., things continuing to be fairly flattish. We don't expect this to change all that much when you look at where things are on the weather front. And when you look at Apple mobility trends, again, something very similar. Now, when we talk about propane, propane is in a very bullish spot at this point. We are now dipping just below where we were on the low end versus 2018. We're now 9.9 million below the 5-year average after a draw of 4.33 million. And this is a fairly concerning spot, especially when you start looking at where are we on the days of cover, which you can see is now below the lowest point, which was, again, that 2018 level. And as we approach 20 days of coverage, that's where we're going to get some fear in terms of, well, what are exports going to look like? Are we going to have to worry about propane availability? And I think this is going to be a bigger focal point, especially when you look at pricing and where some of the growth in U.S. production will be, which in my opinion has always been over the last 12 months or so on the NGL front, because that continues to be. The liquid story is, I think, the bull story, as I said in 2019 and 2020, of the next decade. The liquid story is the bullish side of the underlying energy sector. Now, when we look at jet fuel, here you can see that there was a small build of 320,000. Demand continues to be well off of the normal pace, and based on what we're seeing in the market, that's not going to stop. We continue to be at a very low end versus where we were in 2020 and 2019, and we do expect to see it increase a bit as we go through March. But based on what the airlines are doing, there's not going to be a whole lot of activity, because as we said last week, they continue to take down the 12 weeks ahead. So, it's like globally, the passenger flight schedule for the 12 weeks ahead is 1.3% lower week on week. And it's 1.2, 1.4, 1.7, 1.1, 1.3% below the previous week over the next 12 weeks. And again, that's where we're just seeing a little less activity, not all at once, but just a very gradual reduction, given some of the headwinds. They're just on wages, on economic factors, but also just based on COVID still being that underlying issue. Now on Open Table, you can see that we had a nice little spike on January 30th, but excuse me, we still believe that on the weekend level, we're going to be between 15 to 20% below normal, weekday closer to 25 to 30% below normal. And that's indicative of, I think, a broader issue when we're looking at weather, activity. People are just not doing as much for this time of year. So now in the next segment, we're going to go deeper into what is happening abroad, starting with some of the storage levels and what do we see happening on the differential front as we go through the next few weeks.